Okay, good morning to everyone. Today is Saturday, the 10th of September, 2022, and we will be discussing the part 2 of our introduction to accounting for tax and taxations. And in our part 1, we more or less look at what tax is, and we look at tax with respect to its process or system of administration, which is taxation. And we also reach a conclusion on how we can interchangeably use tax for taxation and taxation for tax. That is not necessarily a crime. Okay, and we are able to more or less narrow it down to the 3 attributes of taxation or tax. And in that case, we are able to more or less look at the perspective of tax as a compulsory levy. And we also look at it that this is a levy that is made by the government or its agencies. And this tax seems to be charged on taxable persons. And we said taxable persons may include a body corporate, which means a company. It may include individual, and it may include enterprise, which also can be seen as individual for tax purposes, and it may include trustees in a trust. All of these are what we take into consideration. And what makes tax important to even allow for a standard to be made for tax is because we know that apart from debt, another thing that is also certain in life is tax. Okay, but we went further in our discussion then to look at the basis of tax. That is, what will be or serve as a reference point in which tax is charged or assessed. And we said it could be based on capital, it could be based on the revenue, it could be based on production or output, it could be based on consumption. It could be based on head count of whatever item we want to consider. It could be based on assets, value. It could be based on costs incurred. It could be based on profit. And of all, we said the one based on profit is what we can consider as income taxes, while every other one based on any other parameter other than profit is considered transaction taxes for financial reporting purposes. Okay, now in this case, when we talk about profits, relatively for financial reporting purposes, we're talking of profits subjected to tax, which are more or less considered as taxable profits. Okay, but again, taxable profit may include total profits, as you know, under Company Income Tax Act and the Petroleum Profit Tax Act, or under the PIA, as the case may be. Okay, PIA stands for Petroleum Industry Act. Okay, we also talk about chargeable profits, which is subject to Capital Gain Tax Act. We talk about assessable or adjusted profits, which you can see under the Tertiary Education Tax Act, CETA. That's a Company Income Tax Act, and PPTA, Petroleum Profit Tax Act, or PIA. Okay, we also look at gross profit from accounting perspective, operating profit from accounting perspective, net profit or net income, which is known as accounting profit for financial reporting perspective, where you might make use of it for things like information technology development levy, for things like NASENI, deductions that we have now, or levy, and things like MPF, trust fund levy. Okay, and as we all said, from an accounting perspective, when we talk about profit, regardless of the aggregate level to which we are talking about profit, we are more or less talking about the process of matching an element of income to an element of expenses that generate such an income. The residual is what we know as profit, provided income is in excess of expenses. Okay, but if reverse is the case, where expenses exceed income at any aggregate level, we can consider such as a loss. Okay, but again, tax is not necessarily paid on loss, but again, we'll see situations, or we've seen situations whereby where you make loss, you are still meant to pay tax. But would that constitute an income tax? I think we addressed that in part 1. Example of such are minimum taxes that you might pay in excess of profit you made for tax purposes, or you pay in excess of not making profit at all, or not having tax due at all, but you are bound to pay tax in that respect. I think we also talk about excess dividend tax, although that is being wound down over time due to the amendments that have come up in Finance Act, where the burden of excess dividend tax has now been limited based on certain exemptions that are provided. Okay, and I think we also discussed on withholding tax. Okay, withholding tax is just an advancement of tax. In most respects, it's not a tax, but in a very cynical or remote perspective, it may constitute income tax. And that is especially when it comes to relate with taxes that is paid on a dividend, and such withholding tax is deemed to be the actual tax and final tax for such an income. Similarly, for foreign services such as technical consulting, management, and professional services, the withholding tax on such foreign services emanating from contract of such nature will be considered as the final tax for that purpose. Okay, I think these are one of those areas to which withholding tax may no longer be considered as advanced tax, but rather as an income tax to that income generated, assuming expenses used to generate such an income is deemed or considered to be nil. Okay, and we went further to use hypothetical figures to illustrate or narrate how we'll take into consideration excess dividend tax, minimum tax, and the likes. And that's what you can see on the screen, I guess. Now, this is just to summarize what we did. And we now venture much more extensively in trying to understand what an income tax is. As we have said earlier, again, and I'm repeating, that income tax are taxes that are more or less based on taxable profit, okay? But later on, we went further to discuss extensively the component of an income tax, okay? And we now, we streamline it into 2, okay? The components, the first component is the current taxes, which are the actual taxes payable based on transaction and performance or profitability of a company in a particular accounting period, okay? And these are payable to the tax authority, okay? And we'll talk about the second component, which we are going to discuss extensively from today, or today, as the case may be, is deferred tax, okay? And we'll try to see that deferred tax is more or less trying to capture the future tax consequences that are not necessarily captured by current tax in the process of computing our income taxes. Now, the future tax consequences of a transaction entered in today or event that occurred today, which are not necessarily totally captured by current taxes, will be captured by deferred taxes. And these arose majorly from a temporary difference. Okay, and we're going to look at all of those scenarios in today's session. And also, we are going to try to understand, as a conclusion, which we are going to reach, that deferred tax is not a tax, rather is a mere accounting measure, okay? At the end of the day, the temporary difference tends to be nil, all things being equal, which means if you sum up your deferred tax provision over the years, you find that as it originates at the initial point, it's expected to reverse to nil at the later point, all things being equal. In that case, it becomes a temporary difference, which make it no tax. And we're going to discuss that extensively today as we go on in our discussion. Okay, that is that. Now, I think we'll start our discussion now with respect to deferred tax. Okay, and before we discuss on deferred tax, I think I better to show what we did also extensively last week with respect to current taxes. And let me just share the Excel model of what we did and the conclusion we reached. Okay, I guess we can all see it here. Okay, let me enlarge it a little. Okay, we came to this conclusion in the last class. Okay. And at the end of the day, we were able to come to this conclusion about accounting for current taxes. First, how do we arrive at current taxes? We start from accounting profits. And what then do we look at? The accounting profits are adjusted for the group of these four items. Non-allowable expenses, which can also be considered as non-deductible expenses or disallowed expenses. Okay. Another group is the non-taxable income. Another group is the omitted allowable expenses. Another group is the omitted taxable income. All of these are what we consider as tax adjustment to our accounting profits. Now, this adjustment will produce what we call profit adjusted for tax purposes, which under Company Income Tax Act or Tertiary Education Tax Act is considered accessible profit or adjusted profit. But under Petroleum Profit Tax Act, this is more or less an adjusted profit, okay? Not accessible profit. Now, the difference between the PPTA and CETA or the likes is that accessible profit is arrived at after allowing for loss relief, which means in PPTA, that means under Petroleum Profit Tax Act, this is accessible profit. Okay, let's take note of that. Okay, whereas under PPTA, this can be seen as adjusted profit, okay, depending on the methodology that is adopted, okay. But let's leave it at that point. That is that. Now, we can relieve losses that are not elapsed following from the previous year, okay? And we also absorb capital allowance subject to restriction as the case may be. This restriction is strictly based on Company Income Tax Act and not based on Petroleum Profit Tax Act or based on PIA. Okay, now, and this is what we call the total profit or taxable profits as the case may be. And we are able to estimate all of these taxes as at that period in time. Okay, and we're able to say the company income tax is 30%. Now, given that this is not a medium-sized company, but a large company for hypothetical purposes, okay, but if it's a small company, it might be subjected to company income tax as 0%. And if it's a company that has a turnover in excess of 25 million, and not more than 100 million, it will be subjected to tax at 20%. But in this case, we can assume that this company, from this case, has 100 million and above, therefore is subjected to tax at 30%. Okay, and that's what you can see. And that 30% is on the taxable profit, which is 11,064 in millions. Tertiary education tax, which is at 2.5% of accessible profit, is as seen. Information technology development levy, which is 1% of accounting profits are seen. NASENI levy, 0.25% of accounting profits are seen. MPF levy, 0.005% of accounting profits are seen. And capital gains tax at 10% are seen. Okay, and that's just the position there, as the case may be. Okay, now we went further to discussed on the fact, okay, I think we talked about capital gain, okay? The capital gain, the 4 million, which is subject to tax at 10%, is coming up from the fact that we have a separate schedule in which we computed our capital gain. And in that case, we say, what is the sales proceeds of on the chargeable assets? Okay, and we sold it for 20 million. We less the purchase price and any other liable incidental cost to purchasing the asset or to enhancing the value of the asset, which make up 16 million. And therefore, we have 4 million that is again to be subject to CGT. Okay, and it was subjected to CGT at 10%, and that's what you can see here. Okay. Okay, that's that. Now we also went into a certain tax position where in the prior period you might have overpaid or underpaid taxes. We consider that also, which you can go back to part 1 of the video to watch. Okay, but again, when it comes to remittance, when I think somebody asked a question, and we said any withholding tax you have so paid earlier, okay, which is an advance payment of tax, will be used to offset only the company income tax. Okay, so that what is actually paid under company income tax is now 5636, having utilized your credit note of 5428. Okay, likewise, we have tertiary education tax, we have information technology development levy, we have NACENI levy, MPF levy, and CGT. All of these constitute your total corporate tax payable to, for example, FRS takes or collects all of this on behalf of various funds, as the case may be. Okay, and I think that's what we discussed. In addition to that, I think we discussed something on, okay, let me show you this also, in order to refresh our memories. Yeah. Also, we discussed things on how we decompose this current tax in the books, and we did that. As you already know, the income tax consists of these two components, the current taxes and deferred tax, and this is how we look at it. Now, deferred tax may be credit and may be debit. Debit is a charge which increases your current tax expense to arrive at 950 income tax, while deferred tax can also be credit, which is like an income. Okay, and which is negative, in this case 103, it reduces your current tax expense to 980 in order to arrive at your income tax. Okay, and we also said that in the balance sheet, you must ensure you separate current tax payable from deferred tax liability. Okay, current tax payable is usually a component of current item. Okay, now current tax payable belongs to current liability based on the fact that this is the amount of tax payable not more than 1 year from the reporting date. Okay, and likewise, deferred tax is not a current item. At all point in time, deferred taxes constitute a non-current item. Now, if it's a deferred tax liability, it's a component of non-current liability. If it's a deferred tax asset, it's a component of non-current assets, okay, as the case may be. And you can see here, to arrive at your current tax payable is your opening balance from last year. Remember, taxes are paid on a preceding year basis, okay, which means tax of last year will be paid this year. Therefore, most times you'll find out that your standing liability, all things being equal, of your tax balance at the beginning of the year, it's your exact amount payable last year, assuming in the context that withholding tax is not applied. Okay, and therefore you have 610 in this case, and you add the current tax charge and you pay what you pay. And remember, you will have paid what was last year this year, which means what you're carrying forward is more or less, all things being equal, that of this year, 845, which you carry forward to next year. And next year has come, we have computed the tax at 1083, and we also paid the one for last year, this year, and that's how we continue to do, all things being equal. Whereas when it comes to deferred tax, similar thing occur, but deferred tax does not necessarily result in the actual payment of tax from this account. It's just a mere accounting measure to capture the consequence of taxes that will more or less be impacted on the account and the cash flow at a later date as a result of transaction and event carried out in the past periods, okay, which we are going to consider extensively in this part 2. Okay, now in this case, you have a charge of 105 for the current period, which increases the balance we have as our liability to 430, and this 430 is carried forward. And conversely, in the second year, we had a credit that reduces this 430 by 103 to 327. Okay, and that's what we mean by that. And all of this is saying that your current tax charge of 845 is here. Your deferred tax charge of 105 is here. The sum of it is 950. Likewise, the current tax charge for this year is 1083, which is 1083. Now the deferred tax credit is 103, which reduces 1083 to 980. And that's that. And I think we also make mention of how to make adjustments in an uncertain tax position. And we carry out this assessment to show that any underpayment or overpayment of taxes is treated as a change in accounting estimate in line with IAS 8. Okay, you can go back to the video as I've said last week. But again, that is premised on the fact that these differences are based on judgment and some other things, estimation, okay, but they are not strictly based on the fact that you have committed an error. Okay, when errors has been actually committed, for example, where you're supposed to add back depreciation, you are deducting it again, which means you've allowed affliction to rise the second time. And in that situation, therefore, that is strictly an error, and that will be corrected for retrospectively. Okay, what it means is that you have to go and restate your account of previous years. Okay, but in these other cases, it will be treated prospectively because it's a mere considered change in estimation, or because estimate is a function of assumption made, is a function of the judgment made, and is a function of the basis of such an estimation, which might run contrary with what the tax authority might consider. As we all know, there are lacunas that give different interpretations to certain transactions or events that may impact taxable profit for tax purposes. And on that premise, what then do we do is to treat such additional taxes or refundable taxes arising from such audit as a change in accounting estimate, and such requires prospective accounting. Okay, that is that. Now that's, I think, okay, bring us to the end of what we discussed. And I think another thing we discussed is here, the amount of tax is attributed to a component of profit or loss. Some are attributed to other component of other comprehensive income. Some are what affect equity directly, which are usually as a result of a business combination. Okay, but every other aspect with respect to deferred tax is what we'll be discussing today. Okay, but before we proceed on that discussion, I want someone to provide, if you have any question, or you want to make contribution, or you want to review your expectation on what we'll be discussing on deferred tax, I'll wait here now. Thank you very much. Any question, you could unmute, any contribution, otherwise we'll proceed with our discussion for today. So I believe you guys can hear me.
Yes, sir. Can hear, no question.
Okay. No problem. Therefore, what will I do now is to go back to my notebook and try to put something down. Today, we'll be discussing on deferred tax. And when we talk about deferred tax, what are we talking about invariably? Okay, let me put up a drawing as far as I can. Imagine you have a non-motorable road and let's pick these two spots. And the road looks like this, which means barely is a straight line. And what then do you do in the interim if government cannot fix the road, which means cannot reconstruct the road in totality, which is the reality of the day, is for you to try and grade the road in such a manner that tends to make it motorable on a straight line. Which means when you measure it, this seems to be a straight line measure for the road. Therefore, if this is it, what you are simply doing is that this is a hole, yeah? For you to do this, you have to fill this hole. Where do you fill the hole from? You fill it from the excesses here. And you dump it on this. This is another hole. Where do you fill it from? You pick the excesses from there. You dump them here. Which means this will call grading of the roads. This is another ditch. You pick the excesses from there. This is another ditch. You pick the excesses from there to fill those ditches, and that's it. At the end of the day, what do you have? You now have what is visible to the eyes as a road slightly motorable, so that you have something close to this. Okay. Now, between the initial spots, the way the road was before, and now, which one is more better? You find out that the second one is more better. And you have not done anything other than grading. Grading means level up. Okay, now this has been leveled up. Okay, which make it more motorable. Not only more presentable, but more motorable, and it allows you to achieve your objective at a minimal cost. Okay, which means now barely can people be changing tires, barely can people be changing shock absorbers and some other things, which is the beauty of the day. Okay, and that is that, unlike the first road. And I can call this before. This is before. And this is what after. Okay, now for tax purposes, for us to achieve this means that we have more or less combined the current taxes. We have combined the current taxes with the deferred tax. Let me put it right here. And you see the reason why. Whereas here, you have only reflected the current tax or current taxes. But here you have reflected both the current tax and deferred tax to produce what I'll call income taxes, which reflect on our discussion in part 1 where we said income taxes comprises of current taxes and deferred tax. Now the question then is, what is a deferred tax? What is a deferred tax? Now I'll summarize it. Now, when you look at deferred tax, okay, I'll look at it from various angles. One, I'll consider deferred tax, which is DT, as an accounting measure that tends to reflect future tax consequences of current period transaction and events as an adjustment to current taxes. That's one. I'm also consider it still as an accounting measure. And you find out that we try to avoid the word, and I want somebody to tell me the word. We can also consider it as an accounting measure used to match the tax effects of transactions and events with their accounting impacts. And thereby produce a less distorted results in the financial statements. Okay, now to understand these definitions, there are many things we need to do. Otherwise, you may not better appreciate it. Now, the first is to deduce deduction or deduce the following from the definitions. There are one, deferred tax, DT, is not a tax. Why? Because in all of our expression, we said DT is a mere accounting measure. A measure means an estimate of value. And what do we need it for? We need it as an adjustment to current taxes. And the reason is to produce income taxes. And remember, anything that's an adjustment, as you can see, is plus or minus. And that's why you find that a deferred tax could be an addition to a current tax expense, which we call deferred tax charge or deferred tax expenses. And it can be minus to current taxes, which means a reduction in current taxes. And that is simply deferred tax credit or deferred tax income. And why are we making these adjustments? We are solely making these adjustments in order to reflect the future tax consequences of current and past period transactions and or events on income taxes. Now, this is one step to understanding it. Another step is to say, can we delineate, or can we on a granular basis explain what gives rise to deferred tax? Apart from the fact that we've tried to justify what it is by saying, one, it is no tax. Two, is an accounting measure. Three, is an adjustment to current taxes. And four, it tends to reflect what was missing in current taxes, which is the future tax consequences of transactions that are already been incurred or events that has occurred. Now, let me delineate it. We don't say deferred tax. Now say deferred tax. Deferred tax is giving rise to as a result of temporary differences, which I'll call TDs. Okay, next. Temporary differences can be considered taxable which I can call TTD, and can be considered deductible. DTD for short. And also temporary differences that are taxable will likely give rise to deferred tax liability, which I'll call DTL. And deferred tax assets is giving rise to as a result of deductible temporary difference. And that is not far-fetched from the fact that we have applied on these two the relevant or appropriate tax rates. All of these are what we're going to consider. Which means that this diagram will tend to explain to us what deferred tax is all about. Okay, and all of this will give birth to the following questions. The first question. The first question will be, what are temporary differences? What are temporary differences? The second question will be, when can a temporary difference become a taxable temporary difference? The third question will be, when will and how can a temporary difference be considered as being a deductible temporary difference? The next question will be question 4. How do we determine a deferred tax liability? Question 5. How is deferred tax assets computed? And the last question. Which is question 6. What rates or rates of tax is or are applicable or relevant for the deferred tax computation? Okay. These questions, our ability to answer them will open that door forever on our understanding of what is deferred tax, the role it tends to play, and how we can more or less effectively determine it for financial reporting purposes. Any question at this point? Any question at this point? Okay. Now let's pick it one by one. What are temporary differences? Now, temporary differences can be viewed initially from two perspectives. A, income statement approach. And under this approach, we view temporary difference as the differences between the accounting profits and the taxable profits, which means where accounting profits does not equal to taxable profits, we have created a temporary difference. The second one is the balance sheet approach. The balance sheet approach is saying temporary differences is seen as the differences between the carrying amount and tax basis of assets and liabilities, which means where the carrying amount is not equal to the tax base of assets and liabilities. In that case, what you produce is a temporary what? Difference. Okay. Now, which of these two approaches can we use, or can we use them interchangeably? I will explain. But I want you to take note of something. Key notes. IAS 12 allows only the balance sheet approach, or what you can call the statements of financial position approach, or the financial position approach. Which means this approach is what is allowed. Let me use green. And this other approach is not permitted. And I'll tell you why. Initially, the two approaches should produce or produces the same result. And this is only possible under the following guidance or situation. One, where the company transactions are not that certificated, and in that situation, the company does not have transactions that give rise to other comprehensive income. Two, the company does not have transaction that bypasses profit or loss and affect equity directly, of which the transaction may have tax consequences. Which means there are no transactions of tax consequences that were rooted or that impact equity directly without going to profit or loss. Three, that in the reporting period or prior periods, there were no tax losses, nor tax losses allowed to be carried forward. Four, that there are no unutilized tax credits, in this case by way of capital allowances, that are allowed to be carried forward, or because all of the capital allowances are fully utilized. It's only when you have all of these situations not in existence that income statement approach and balance sheet approach will usually give the same results. But the reality of the day is that most times, at least one of those ones that we don't expect to occur are usually integral of a transaction of a company. And thereby, in most cases, except for very small companies, profitable ones, for tax purposes, will we have opportunity not to come across any of those 4 or more? Which means that since it's much more unlikely to avoid any of these 4 or more, it then creates a difference between what temporary difference you derived from income statement approach and from balance sheet approach, thereby necessitating the use of an approach that is much more encompassing, that with or without those transactions occurring, every element of deferred taxes will be captured as a result of the existence of temporary difference. And that is why the IAS, in its conclusion of the best methodology, adopted the balance sheet approach. And for the whole process of our discussion here, we'll be making use of the balance sheet approach, which speaks to the fact that temporary differences are differences arising from the fact that the carrying amount of an asset or of a liability is invariant or differ from the tax base of the same assets and liability. Now, the next question, if you could remember, was that, okay, if we now agree on what constitutes a temporary difference, the next question then is, when can we ascertain that a particular temporary difference is taxable? And what does that mean? When is a temporary difference taxable? Now, a TD will be considered taxable if its existence could give rise to increase or what I could call higher taxes in the future periods. Which means if, as a result of transaction or event you have carried out today on prior periods, in addition to the effect that he has given to you with respect to current tax today, he still has a likelihood of exposing you to higher taxes in the future, assuming all things being equal. It then means that such temporary difference is giving rise to additional tax, which the word taxable is framed from. Because when you hear taxable means you have to be subjected to tax, means it will take you from grand zero to grand zero plus, which can be to 1 naira, to 2 naira, to 10 million naira, to 1 billion naira in additional taxes. Which means that any temporary difference that has a likelihood of exposing you as an entity to higher taxes in the future, all other things being equal, such a temporary difference is considered taxable. Or because it has exposed you to you having higher taxes in future, even when the taxes remain the same. Now, mathematically, how do we express this? Mathematical expression of taxable temporary difference. One, for an asset, you have a taxable temporary difference when the carrying amount is higher or greater than the tax base. And we're going to see that later. But conversely, for a liability, a taxable temporary difference is when the carrying amount is lower than the tax base. Which means in this case, you have carrying amount greater than tax base. In this case, you have carrying amount lower than the tax base. Now, what if the carrying amount and tax base are the same? What do we consider that to be? Who can answer that? What do we consider that to be?
Temporary difference.
What?
No temporary difference.
Which means there's no temporary what? Difference. Thank you. Now, let us now compare that with the third question. When will and how can a temporary difference be considered as being a deductible temporary difference? When is a temporary difference deductible? A temporary difference is deductible if and only if the temporary difference will give rise to lower taxes as a result of the current and past transactions and events which means as opposed to taxable that give rise to increase or higher taxes, temporary difference will give rise to lower taxes, which is the opposite. Now, similarly, mathematical expression the mathematical expression of a deductible temporary difference we also pick it one by one. For an asset, it is deductible when the carrying amount is lower than the tax was base. And two, we say for a liability, it is deductible when the carrying amount is higher than the tax base. Now, when you deduce it and you look at the reversion, you find out that what we are saying here is that the carrying amount is lower than the tax base. Therefore, it becomes deductible, temporary difference. But for liability, the carrying amount is greater than the tax base. Now, if you pair them, let me try and close the gap so that I can see them at a glance. Okay, if you pair them the way I've done it now, you can see the common factor is that taxable will give rise to higher taxes, deductible will give rise to lower taxes. Let me pick the point of differences. Increase or higher taxes, yeah, lower what? Taxes. Here for assets, kind amount is greater than for it to be taxable, but where the kind amount is less than, it becomes deductible. For liability, when the carrying amount is less than the tax base, it becomes taxable. But when the carrying amount is greater than the tax base, it becomes what? Deductible. Which then means that if I return to this, I can come up with a matrix. I call it deferred tax matrix, or I can also call it temporary difference matrix. And what is a matrix? The matrix exists. I'll call it 3 by 3 matrix. Okay, now I can call this the basis of determining temporary difference. Now, the first stretch of basis is to say temporary difference from the balance sheet approach is based on 2 things: assets and what? Liabilities. Therefore, the first basis is to extract what are the assets of the company and what are the liabilities of the company. We'll pick them one by one. 2, the parameter for judging is now to make comparison between the carrying amount and the tax base. Therefore, I'll compare if the carrying amount is greater than the tax base, or if the carrying amount is less than the tax base. Since we know that if they are equal, there is no temporary difference. Therefore, what we're interested in is where there are temporary what? Differences. Now, let me call this my pivot cell, my important cell. And this cell, let me assume for now, which we're going to see later or prove later, to be the convention. And what's the convention is that we already kept abreast, even though we'll still illustrate it later, why it is so. That whenever the carrying amount of an asset is greater than the tax base, we say such is taxable temporary difference. It then means that we've taken this as our convention. Now, other ones cannot be solved by way of puzzle. I can solve it by way of what? Puzzle. What is a puzzle? There's a logic in this case. And what's the logic? The logic is this. If you say on one hand that asset and liabilities move in opposite direction, and you have made a submission here or a conclusion here that whenever the kind amount of an asset is greater than the tax base of that asset, you've concluded that the temporary difference is taxable. The question then is, what if it is not an asset, but it is a liability, and the kind amount of that liability is also greater than the tax base? Will liability and asset move in the same direction, given that you have said that asset and liabilities are in opposite direction? The answer will have been no. And if it is no, in that case, it means where the kind amount of an asset is greater than the tax base, and you said it's taxable, automatically, if it's a liability, you can't say it's also taxable. It will be opposite. And the only opposite of a taxable is deductible. Therefore, I'll come here and say, where the kind amount of a liability is greater than tax base, I'll say it will give rise to a deductible temporary difference. That's the first way of solving that puzzle. To complete others, I also come back here. You said an asset where the kind amount of it is greater than tax rate is taxable. Are we going to say the same thing if the kind amount is now lower than the tax base? The answer is that no, it won't be the same, because greater than and less than are opposite direction. Therefore, conversely, I cannot deduce that for an asset, whenever the kind amount is less than, it will give you opposite of where the kind amount is greater than, and the only opposite we have is the deductible temporary difference. Therefore, I'll come here and say, I have a deductible temporary difference whenever the kind amount of an asset is less than the tax base of that asset. Now I've solved that puzzle. The last puzzle, I can solve it in two ways. One, I said assets. Whenever its kind amount is less than tax base, we said it's deductible. What if it's not an asset but a liability? When the kind amount of a liability is not less than tax base, will it give me the same result as when the kind amount of an asset is less than the tax base? No, because asset and liability are opposite, which means if asset has gone in this direction, under the same notion of less than, liability will go in the opposite direction under the same notion of less than, which means for liability, it won't be deductible, but it will be taxable. Another way I can solve it is also for liability. When the kind amount was greater than tax base, you say it was deductible. Now, if we still retain the liability, but we tweak it that it's no longer greater than, but less than. Less than and greater than are opposite, which means for greater than to show deductible, less than will show what? Taxable, which is the opposite. Which means regardless of how I solve the puzzle, I'm still coming to a conclusion that whenever the kind amount of a liability is less than the tax base, what I will always produce is a taxable temporary difference. Does this make sense to you at all? Now let me minimize it. And see the picture at a glance. Any questions so far? Any questions so far? Or any contribution? I'm not hearing your voices today. is either two things. One is sinking so fast, or you are waiting for when it will start to sink.
Actually, sir, thank you very much. Actually, I really do not have a much question, but actually before the commencement of the class, I've been having this kind of thoughts that since we already have income tax, so why is it necessary to be calculating deferred tax? So what's the essence of deferred tax and all of that? I now understand that is a future tax. What's it called?
Well, I've gone through this class before, deferred tax class before, but I don't understand. I think with your explanation, I understand better now.
Okay, what do you understand better there? What is new?
Well, the way it is being computed, actually, I think I understand the genesis and the revelation now. Yeah.
Okay, I didn't know deferred tax as genesis and revelation. I understand what you mean, the beginning and the end, I get it. Okay, who else? Okay, now we've laid the foundation, but again, the foundation has only answered the first three questions. What are temporary differences? Which is this? Second question, when can a temporary difference become taxable? Which is this? And the third one is when will and how can a temporary difference be considered as being a deductible temporary difference? Now we have four other questions left to be answered. One, how do we determine a deferred tax liability? Two, how is deferred tax asset computed? And the last three, what rates or rates of tax is or are applicable or relevant for deferred tax computations, which means we're already in the half of the question and we'll continue with the other half. Okay. Now the next question we'll be looking at is how do we determine a deferred tax liability? How do we determine a deferred tax liability? Now, deferred tax liability is a product of the tax rates and taxable temporary difference. What it simply means is if your temporary difference is 10 naira and your tax rate is 30%, your deferred tax liability is 3 naira. The same way, your tax payable is the tax rate multiplied by the taxable profits. Which means if your profit is 100 naira and your tax rate is 30%, your tax will be 30 naira, which is 30% of 100 naira. And that's what we're trying to do here. The next question then is, how is deferred tax asset computed? As it computed, deferred tax assets is computed as the sum of the product. Now, not just the product, and I'll explain. The sum of the product of tax rates multiplied by deductible temporary difference and the word sum means plus the product again of our tax rates multiplied by unutilized tax losses allowed to be carried forward, plus once again, the products of tax rates multiplied by unutilized tax credits carried forward. Now the DTA is the sum of the product of the tax rates multiplied by the deductible temporary difference, as we have it up here. But in addition to that, we also sum up the product of the tax rates multiplied by unutilized tax losses carried forward, plus the tax rate of unutilized tax credit carried forward. Now, let me refresh your mind and take you back to what we did last week in part 1. Remember, your inability to absorb your loss in a current period will necessitate you carrying the loss into a future period, which creates a potential reduction in your future taxes, because the loss of a year will be used to reduce your tax in your future period. Thereby, this creates a possible reduction in future taxes, which is a deductible temporary difference, which is whatever is left as profit carried forward here, which in this case is nil, will have created a deferred tax asset by way of deductible temporary difference. Similarly, capital allowance is a tax credit given for you to reduce your taxes, and whereby these allowances were not totally absorbed in the current year. The balance unabsorbed or unutilized will carry forward to the next year. And what does that presuppose is that your future taxes will be suppressed, will be reduced by this unutilized tax capital allowance carry forward or credits carry forward. Now, these two, whenever they exist, other than zero in this case, they give rise to deferred tax assets, all because the difference here is considered deductible temporary difference. Okay. Let me go back to our note. And that's what we try to achieve here, which means deferred tax asset goes beyond just the deductible temporary difference as determined. Yeah. It goes further to address those that may be attributed to unutilized tax losses carried forward, and those that may be attributed to unutilized tax credits carried forward. But any of the tax losses or tax credit unutilized that elapses, like in Nigerian case, for most companies, loss cannot be carried forward for more than 4 years, except for manufacturing, agric, and agro-allied. But in Nigeria, tax credits such as capital allowance unutilized can be carried forward perpetually in that case. Now, that has answered question 4 and question 5. Now, the last question, which is question 6, is what rate or rates of tax is or are applicable or relevant for deferred tax computations? Now, the rates is a function of two things. Function of the mode of recovery, of an asset or settlement of a liability, and the nature or status of the tax. These are the two functions which I can say mode of recovery of an asset or settlement of a liability. It can be either through use or through disposal. Now, we'll pick asset in this context. The way you can realize your value of an asset is either you make use of it or you sell it off. You make use of it to generate income and cash flows, and you sell it off to accelerate the generation of income and cash flows. Whereas the nature or the statute of the tax will either be enacted tax rates or substantively enacted tax rate. What's the difference? Now, when you make use of assets to generate income, such income in Nigerian context is usually subjected to taxes like PPTA for upstream exploration, CIT, company income tax for other companies. In addition to that, PPT, CIT, TET, and the likes. While for disposal, you are subjected to CGT, which means if the asset is an asset that will be subjected to disposal, CGT will be applicable, which is at 10%, for example. But if it's subjected to use, depending on the nature of the company, it may be subjected to petroleum profit tax, company income tax, or tertiary education tax. And that's the case. Okay. Okay. Now, that is one. The second is this. If it is enacted rate, what is an enacted rate? For example, currently, every ruling rate or rate of tax that is in force in Nigeria today are all considered enacted rates, which means enacted rate in this case are ruling rates of tax. In Nigeria today, CIT is about 30% for big companies, 20% for medium size, and 0% for small companies. Tertiary education tax is 2.5%. PPT falls between 85, 50%, 65.75, depending on the stage, the nature, and the nature of your contract, whether it's JV or it's PSC and some other things like that. Okay. Now, but when a new rate yet to be in force, that is yet to become effective, exists, such new rate is considered substantively enacted tax rate. And it's substantively enacted tax rate either when it has been enacted, but is to become effective as a future date. For example, imagine there's a finance bill that changed rate of tax from 30% to 35%. And they've enacted it, the president has signed it, it becomes a law today, which is today is 10th of September 2022. But the law says it will become effective from 2023 or from 2024. Such a rate is enacted, but it has not yet taken effect. It then will be considered as substantively enacted tax rates. Another thing that we can consider substantively enacted tax rate is it has been approved by the National Assembly, but the president is yet to sign. It's still substantively enacted tax rate. And it's more likely that the president will sign than not. Or it is in the final process of being legislated upon and ratified by the National Assembly, and it's more likely that it will be enacted by the National Assembly and will be signed by the president. For that also can produce a substantively enacted tax rate. The question then is, which rate is applicable in each instance? Is it the enacted tax rate? Is it the substantively enacted tax rate? What are the conditions precedent to selecting which rates? Whether you are making use of the assets or you are disposing of the assets. Which rate? Is it the new rate, which has become not effective until a later date, or the current rate, which is still effective? These are the questions that beg for an answer. And we're going to see with practical illustration how we determine such a rate. Any question? Any question? I believe I've successfully attempted in delineating our understanding from this diagram of deferred tax. Okay, by looking at this diagram in a chronological order and tend to answer these 6 questions. Okay, any question on it? Okay, if there's no question, therefore, I'm going to switch to this and show you a model I developed for computing deferred tax. Okay. Now look at it here. This is the deferred tax computation for 2020, for example. Assuming that we have a balance brought forward from 2019 of 500,000, which is a deferred tax asset. Okay, sorry, deferred tax liability, 500,000. Okay, now in the current period, we itemize all assets and liabilities we have. Okay, property, plant, and equipment, we said is an asset. We can always change whether it's asset or liabilities or not applicable. So in this case, it says an asset. Prepayment, we say is an asset. Dividend, too, says is an asset. Like that, like that. Okay, up to trade payable, cash, borrowing, trade payable, trade receivable, deferred revenue, asset retirement obligation. Like that, all of your assets, you identify them and you itemize them. Now, these 2 I'll explain. Unrealized gain losses and unrealized FX gains and unrealized FX losses. They won't see this in your balance sheet, but why am I creating it? I will explain. They are not in the balance sheet because they have no kind amount in the balance sheet. Because based on accrual principle, whether they are realized or not realized, they are recognized as income and expense. Therefore, there's no balance sheet left. Or because they are already reflected in any of the assets or liabilities as the case may be. But they have tax basis, and we'll explain later. Now, these are the balance sheet figures as drawn from our IFRS accounts. Okay, but these are the tax bases. Again, how do we determine the tax basis and how is it different from the kind of amount? That is one of the next questions we will answer. What is a tax base for deferred tax purposes? And how do we compute deferred tax base for an asset and how we compute tax base for a liability? But in this case, these are the tax bases, of which some of them are equal to the kind amount, while some of them are different, either higher or lower. Some of them that are equal are things like prepayments, things like cash and cash equivalents, things like borrowings and trade payables. Okay, some of them that are higher, that is the kind amount is higher than the tax base, it's things like property, plant, and equipment. And some of them that have it lower as shown. Therefore, some will give rise to taxable, some will give rise to deductible. And if you remember, the word taxable or deductible is premised on this. Let me show you again. You know, we try to play a puzzle, and the result of the puzzle is what produces this, which I've discussed earlier. Okay, which means you compare your assets and liabilities in the balance sheet by comparing the kind amount to the tax base, if it is higher or if it is lower. And we're able to consider this dimension to be taxable and this dimension to be deductible. Okay, now let's go back to our model sheet. And that is what we use to do this. And if you are very familiar, with modeling, exam modeling, you see that there's something running here. And let me try and open it. I think I passworded it. Can I remember the password? Okay, now you can see what is operating in it. Okay, I said if it's an asset, therefore you should pick the excess of kind amount over tax base. Otherwise, if it's a liability, you should pick when it is the kind amount is less than the tax base. Okay, otherwise you should pick is 0. For deductible, is the reverse is the case. It is an asset if the kind amount is less than the tax base, or if it's a liability, the kind amount is greater than tax, otherwise it's 0. And that is why anytime I switch it, you'll see how we switch answer. Let's assume that this is 65 now. We switch away from taxable to deductible. Can you see? And this is what I've modeled. And what I've modeled here is based on the understanding of the deferred tax matrix that I've more or less logically shown you. Okay, that is that. But again, let me return back to, I think this was at 25 million. Okay, and that's how we produce what we have there. Okay, let's also pick a liability value. For example, this is a liability. Let's assume we have something here. Let me say 1.2. You can see that because the tax base of a liability is higher than the kind amount, it's telling me it's a taxable total difference. But where it is lower, let me assume the tax base is 0. It tells me it is deductible, and that is that. Now, how do I get 30% and 32%? As at the time I did this, it was in 2020, then tertiary education tax is at 2%. But now it's 2.5%, which means where I have 32% before, it might now be like 35%, 32.5%. Okay. Let me increase it to 1 decimal place so I can see it. Therefore, all of this one now, and I'll explain why some are 32.5, why others are 30. Again, it could also be 20%. If this 30% will have been 20% for a company with turnover between 25 million and 100 million. And this 32.5 will have been 22.5 for companies within turnover of 25 million and 100 million. You must take note of that. And that's why I've also explained the issue of enacted tax rates. Is it through use? Is it through disposal? What is the substantive nature of the tax rate and non substance? Now, this 30% relates to item of PPE. Why? Because the effect of tax depreciation is below the line. What do you mean by below the line? Let me take you back to what we did in part 1. In part 1, can you remember the effect of capital allowance, which speaks to PPE, is having effect on taxable profit when the rate is 30%. But other items affect accounting profits, which are subjected to tax at both 30% and additional 2.5% being education tax on assessable profit, which means there's 2.5 already charged on this. And before they not charge another 30%. But capital allowance is not within the bracket to which they charge 2.5%, which means the effect of 2.5 will not affect capital allowance. And capital allowance is attributed to item of PPE, and that is that. Why every other item other than loss is attributed to 30%, 32.5%. 32.5 is 30 plus 2.5. That's how I got 32.5. Before it was 30 and 2%. Okay, which means what I can do is that instead of just writing 32%, I'll just write is equals to 30% plus 2.5%. And that's how I got this 30%. Okay. Now, again, you asked me that under this section, I also use 30% again. This 30% is applicable to one, losses. Let me switch back. %32.5%. Okay. Okay, now here I'm using 30% because unutilized tax losses, unutilized investment allowance carry forward, unutilized tax credit or capital allowance carry forward. Okay, all of those ones falls under the regime of 30%, which I can show you again. Yeah. Remember, the effect of loss is not before we charge assessable profit to tax, which is 2.5%. It was after, which means the 2.5% will play no role on loss relief. Likewise, the capital allowance is after assessable profit, of which 2.5% will also not play a role on capital allowance, which means the result of all this carry forward, including where we have investment allowance carry forward for that period, are totally going to have effects only at the rate of 30%, which is on this total profit. And that is the reason why. Okay, which means you must have deep understanding of all of this to be able to be a good accountant where you can be able to put up this structure. Okay, even though this structure looks like plug and play, but if you don't have understanding of the basic principle, one, you won't be able to construct it. Two, even when they give you the template, you might not be able to make use of it for various situations. Now, that is that. Now, if you look at what I've done here, the sum of all deferred tax liabilities arising from taxable temporary difference is summed up here as positive. Okay. The sum of all deferred tax assets arising from deductible temporary difference is summed up here as negative. The effect is that this reduces this. And this deferred tax assets here has not included other items such as unutilized tax losses and unutilized tax credits. If remember, as part of my discussion then, You'll have seen something like this before. Let me switch it. And what do you see in that instance? That when it comes to deferred tax asset, it's not just restricted to deductible here, it also includes the carry forward of unutilized tax losses and the carry forward of unutilized tax credits. Okay, those are the things that I've also considered in building the model. Okay, now in doing so, this element of deferred tax asset arising from unutilized tax losses and credits, which is 3.9, comes here. And that 3.9 is made up of unutilized tax losses carried forward, 3 million, and unutilized tax credit, 2 million, which means the whole effect of deferred tax assets is 7,670,000. Whereas the effect of deferred tax liability is 785. The net effect of it is 155 liability. Okay, now we'll now compare that 155 liability with your opening balance of 500. You find out that you have created a deferred tax credit, which means your liability has reduced from 500 to 155, which means you have created an income in that respect. But if your liability has increased from 500 to 600, you have created an expense of 100. Now, let me tweak something to make it higher. Let me take this and put this at 20 million, for example, or let me put at 22 million. Now, at 22 million, you can see that you have created a net deferred tax liability of 1,055,000. And remember, you had 500,000 before. It then means you have created additional expense to increase your liability from 500 to 1,055,000 by how much? 555,000, and that is it. And that's that. Now, how do you determine tax base? Some of them flows from capital allowance computation, which you have your schedule of capital allowance and your schedule of this, and you already know that as a tax professional, how you compute your capital allowance and how you determine your carrying amount forward and all sorts of things. We are going to look at that and illustrations. And also look at various principles of what do you add back, what do you deduct in order to arrive at tax base. We are going to look at the definition of tax base for assets and liabilities, and we're going to use that to reach a conclusion. And that is just it in this context. Any question so far? Any questions so far?
All right. I have a question, sir. From these templates, from this modeling, I can see carrying amount and tax base, and I see that the tax base actually relates to inventory, trade receivables. Is it possible? My question is it possible for the tax authority, or who computes the tax base? Is it the tax authority that computes the tax base, or is the is the accountant? That's number one. And number two, is it possible for the tax authority, if they are not calculating it, to calculate the tax base for inventory or trade receivables or all of these assets? So I want to be very, fair about it.
Okay, the first question is this, which I'll put to you. Is deferred tax a tax? From what we've said so far, even though we've not proved it, we are going to prove it. But is it a tax? From some conclusions we've started with at the introduction level.
It's actually not a tax itself.
Okay, thank you. Now, you said that it's not a tax. I agree. But we've not proved that. We'll prove it. And two, if it's not a tax, have you ever seen in tax law or in FRS guideline, circular, or have you ever seen where they say bring your tax, deferred tax schedule, bring your deferred tax? Have you even heard of that from tax authority? It is not a tax, therefore, why are they bothered? They are not. Yeah. Therefore, the first question has been answered. People say in the local parlance, they'll say, what concern Agbero with overload? Which means, what then is when tax law does not know about deferred tax, does not, therefore, why would the tax authority come and compute anything? Anything you compute is for your own sake, and probably for financial reporting purposes, which has no bearing in tax law, which means it is the responsibility of an accountant. And why are we doing this? I said earlier that is an accounting measure. It's an accounting measure, and we are doing it as an adjustment such that, because we know that current taxes may not be a true reflection of our income tax based on our financial performance, therefore we are adjusting for it. And why is it not the same? Because current taxes only consider tax impact from the angle of the tax law. And the way the tax law recognizes accounting profit, not accounting profit, and profit, which we call taxable profit, varies from the way financial reporting, or IFRS, recognizes such transactions and performance with respect to accounting profit. Therefore, the profit to which they are subjected to tax is not accounting profit. And it will not be wrong for us to take a tax that is not based on accounting profit to reduce accounting profit in the financial statement. Therefore, let us now use the same tax understanding to arrive at what is the appropriate amount of tax applicable to accounting profit. Because you are not presenting your financial statement with respect to taxable profit. Have you ever seen a financial statement, how they prepare account that is showing your taxable profit? Have you ever seen it? You prepare accounts that reflect accounting performance, profits, financial performance. Therefore, there's a mismatch. You are more or less using current tax, which is probably cash basis, as a deduction of profit in accounting that is more or less accrual basis. Therefore, why can't you now adjust, pay whatever amount of your current tax is based on the law, but accounting-wise, adjust for it, upward or downward, to make it reflect income tax that is much more of accrual basis of accounting and in tandem with the principle of financial reporting rather than the principle of tax laws. And the issue there is this. Apart from permanent differences that will not give rise to deferred tax, every of those other differences, which are considered temporary differences, though at origination it creates a difference, but that difference is temporary, so that at the end the difference goes off. Why? Because the current tax over the years will sum up to income tax over the years. All of these things are the proof we are going to do to make it clear, so that it's not just descriptive, but we quantify it. And you see how over time, deferred tax tends not to be a tax, but a mere placeholder for the period of timing difference where we have those temporary differences and we need to make a cover up in order to ensure that we have this road, which means if government cannot yet do the road in our locality, we can bring a grader to grade the road without necessarily adding anything to it, just to level it up. And that's what we've done here. And that's the role deferred tax is trying to play. And we're going to see it. Does that make sense, sir?
Yes, sir, it makes sense. And sorry, okay, I don't know if we are still going to do that, but I just want to ask how we're going to arrive at that tax-based computation itself.
Yeah, when we get to that, I've said earlier, we'll have to define what a tax base is, which is the next stuff we're going to consider. What is a tax base? Okay, but before we consider that, we'll just play with a simple illustration to explain some other things. So that the more we explain simple things, it will unravel how we explain complex things, and thereby having a better understanding of all of it all. Does that make sense to you?
It's all right, sir. Thank you.
Okay. Any other question? Any other question or contribution?
Sorry, I actually remember that the last session we had on current tax, I asked a question of that deferred tax, that do we actually aggregate it, like in the statement of financial position? And you said you're going to attend to that this week. I don't know.
Yes, and I believe if you go back to this schedule, we did something here. What does this signify? If you have followed me in the last few minutes, and I even explained it, what does this signify? The deferred tax assets.
It has been aggregated together, like if tries to.
But again, yeah, again, it is done like this because one, in Nigerian context, we only have, when it comes to company taxes, company income taxes, or current taxes for corporate, we only have one taxing jurisdiction, which is the FRS. And that's one of the reasons why we are able to offset like this and just pick this final figure. But in the US, corporate taxes are administered at various state levels. Therefore, if you now have activity in different states, you won't be able to aggregate it like this. You have to treat each state differently. Therefore, which means in one state, your transaction there might give rise to deferred tax assets. In another state, your transaction there might give rise to deferred tax liability. You can't offset because you can't use tax of one state to offset the other state. That means in that case, we can't offset the way we have done it like this. Two, even when you are in IFRS, you are only having FRS as your taxing jurisdiction. You might also not have deferred tax assets coming from the same tax regime. What is a tax regime? CITA is a tax regime, Company Income Tax Act. What is a tax regime? PPTA is a separate tax regime. And you can't use CGTA, also is a tax regime. That is a Capital Gain Tax Act. Therefore, you can't use deferred tax assets in capital gain tax to offset deferred tax liability in Company Income Tax Act. As you all know, if you overpay tax in CIT and you underpay tax in CGT, will FRS now say offset? FRS will say, okay, for the one you have overpaid, we'll give you credit note, but the one that you have underpaid, you pay. You even pay penalty and what? Interest. All because of what? They are two separate tax regimes. They don't know one another. And they are totally independent. Which means the general principle of offsetting assets or liabilities, whether it is for tax purposes, is financial instrument purposes, or whatever purposes it is, as we will discuss it in each of those standards that we come across, is that two conditions must always prevail. The first condition here is that there must be legally enforceable rights for you to be able to offset, which is the case of me saying, if it's only FRS and it's only one tax regime, there's legally enforceable rights. But if it's only FRS, but there are two separate regimes, there's no legally enforceable right to offset your excess in CIT with your shortfall in CGT. No. That's why I also explained earlier that withholding tax is an advanced payment of current tax, and that's a company income tax, not advanced payment of taxes. Though we use that word, but it's not advanced payment of taxes, it's advanced payment of company income tax. That is why you can only use your withholding tax credit note to offset company income tax. Imagine this is like 12 million, or let me say 15 million. You can't use the excess of 3 million to go and offset other taxes. Like, it's not possible. You will have credit note for this, and you go and still pay this separately because they are separate tax regimes. And that is what we try to speak to in that. And again, I make an example. If you're in the US, if you have branches, you have to prepare branch account to determine your tax payable in each of those branches based on those state law tax. And you can't offset in that case. That means the deferred tax asset, deferred tax liability, current tax liability, or whatever it is, cannot be offset in one tax jurisdiction against the other, or in one tax regime against the other. Otherwise, it can be offset. Does that answer your question now?
Yes, sir, very well. Thank you.
Okay, you can see that if you have not brought it back to here, if I've explained it somewhat, yes, you may get it, but it might not be as fruitful as it is now.
Yes,
does that make
yes.
sense? Yeah.
Yes.
Okay. Now, before we talk about tax base, let's look at simple illustrations, okay, that will refresh our memory so far on what we've done, okay? Okay, now let's refresh our memories with this question. I want somebody to read this question and we'll prefer suggested solutions to it. Okay, can somebody read?
Given the following financial information as extracted from the accounting records of Rationale PLC, estimated income tax for year end 31st December 2014, 85 million. Income tax paid during 2014 in respect of tax for 2014 as agreed with FIRS is 90 million. Estimated income tax for the year end 31st December 2015, 100 million. Required, determine the appropriate amount to report for year end 31st December 2015 with respect to income tax expense and current tax payable. Should I go ahead with the second question?
No, thank you. Thank you. This is a question. Let me just put it on one side here. Okay. Now, I need to determine two things. My income tax. My income taxes for which year now? Our current period we're reporting is 2015 for the year ended at 1st December 2015. Okay. Now, all figures are in millions. Okay. Now, what is income tax? It's made up of current taxes and deferred tax. Whatever the amount is the sum of these two. Now, from the question, you were told that last year the estimated income tax to be 85, but this year in 2015, they discovered this 2014 should be 2015. Let me update it. that is during 2015, which is the current year. During 2015, in respect of tax for 2014, we agreed with FRS. Agreement with FRS means that they've done tax audit and reconcile that this 85 ought to be 90, which means you have underprovided for tax last year. Therefore, that has created uncertain tax position, which give rise to underprovision for tax in prior year. Now, this brings about additional tax of 5 million, which have to be adjusted for prospectively in 2015, which is the current period. Now, how do I arrive at that? My current taxes. What is my estimated tax for the year? My estimated tax for the current year, 2015, is how much? Is 100 million. Now, what is the impact of underprovision? You add underprovision for tax in 2014. I see that amount that you are going to pay as additional taxes is a tax for 2015, which is a prospective accounting. Therefore, what do I do? Prospectively, the tax of 2014 that was underpaid by how much? By the difference between 90 million as I go with FRS and 85 million, which we self-assessed and filed. Therefore, we'll have a difference of how much? A difference of 5 million, which constitute additional taxes. Now, this additional tax, which is 90 minus 85, will be used to increase your current tax from 100 to 105. And this 105 is what to bring up here as your current tax for 2015. Now, in this year, there was no deferred tax information. Therefore, we assume now that deferred tax is what? Nil. Okay, at the end of the day, what's our income tax? Is 105, assuming there is no deferred tax. Now, what is the amount of current tax payable? Current tax payable as at end of the year, all things being equal. My current tax payable is my balance as at last year, which is brought forward. Remember, this is same as at 31st December 2014. I remember, because tax are paid on preceding year basis, it then means that the 85 we provided for have not yet been paid as at 2014. And therefore, that will have been our liability brought forward in 2015. Now, in 2015, we have charge for the year. What was our income tax charge for the year? That's our current tax charge for the year, 105. Okay, which is this. Charge for the year is 105. And this naturally should give us what we are owing as at the end of the year. But we are aware that we have paid how much in 2015 in respect of 2015. As I agree with FRS, we have paid 90. Okay, which means though we are supposed to be owing 85 and 105 to make up 190. But the amount of tax paid during the year 2015 was how much? 90. Okay. Now, what then is our balance as at the end of the year? Balance as at 31st December 2015 will have been 190 minus 90, which is 100. Now, this 100, all things being equal, can be traced to what? This 100 can be traced to this 100, the current year. Why? This 5 along with the 85 will have been paid at 90. Let me give practical experience. When FIS come to audit your last year tax filing, any additional amount is payable within the next 21 days, 14 days, 7 days, whatever they say, 30 days, all things being equal, which means you don't delay it along with your tax for this year to be paid next year, no, because the year it was immediately due has already passed. Therefore, you can't wait and say you want to treat it because in accounting, you treat it as if it's current year tax. Therefore, I'll pay it when I'm to pay my current year tax. No, you have to pay it immediately. And that is why this 90 was agreed to be paid immediately, which comprises of 85 self-assessed and additional 5 arising from your under provision for 2014, which means this is the balance to be included in your current liability. In your current what? Liability as current tax payable. Okay, that is that. Any question?
Sorry, sir. I didn't get one part of this thing. So income taxes are usually made up of both the current tax and deferred tax, if I understand by what has been written down. So why is it that the 5 that was paid for previous years was included as part of the current tax? As in, why did we add the 5 as part of the current tax? Then secondly, if income taxes is made up of deferred tax and we have a 0, what happened? Why do we have this 0? I'm sorry, I lost maybe my network or something. I'm done with the question.
Okay, thank you. Now let's take it one by one. Now, can you repeat your first question so that I'll answer that? And after that, you repeat your second and I'll answer that.
Our income taxes is made up of current tax and deferred tax. So I'm asking that, why did we include this 5 that was paid as an, and that probably is part of last year tax, as to be part of our current tax that make up the income tax? And secondly, if you said income tax is the...
Let's pick it one by one. That's why I say you should repeat it one by one.
Okay.
Now, I've explained to you that whenever you assess yourself to tax, except for what is evident as error. Errors are like whether intentional or non-intentional. The tax law says accounting depreciation is not allowed, and you forgot to disallow it. That means you forgot to add it back, and you still go back and charge capital what? Allowance. Or where you're supposed to add it back, you deducted it again. Such error, if it results in additional taxes, is an error. Such tax will be treated retrospectively in line with IAS 8, which means you must go back and correct for the year of that error and restate your balances as it is. But if the additional tax is as a result of, for example, there's a general provision that talks about only, reasonably, exclusively, and all sorts of things incurred. And on that basis, you are having argument with FRS on, no, this expense is only acceptable, it's not only acceptable. At the end of the day, you reach a compromise, which is an agreement of so much. At the end of the day, it will lead to additional taxes. Such additional taxes are treated as a change in accounting estimates. And what is the requirement of change in accounting estimate? I think you guys have not also gone to listen to my lecture or video material that I've told you to do that. Is to prospectively adjust. And what is prospective adjustment? Is that you treat that as a new information you are getting in the current period, which the impact also needs to be recognized in that current period. Are you getting it now? Rather than going back to restate. Okay. And that is why we treat any additional tax or refundable tax as a change in estimate that requires a prospective accounting by adjusting for it in the current period taxes. I've explained severally, financial reporting is not just pre-countries, it's not independent, it's holistic. What that means that you need to have some underlying understanding and background. And that's why when I say let us do something, please let us do that, because it has implications. Otherwise, there's no way you can have understanding of one particular standard without having understanding of some other standards, because they are interwoven to a certain degree. Does that make sense to you now?
Yes, yes.
Okay, what's the second question?
So my second question is, if for the year, it comprises of both current taxes and deferred taxes, why do we have zero as our deferred tax for the year?
Okay, I'll explain. The question before us assumes that there is no deferred tax or there's no temporary difference, therefore deferred tax is zero. Therefore, we can't manufacture deferred tax from nowhere. But as the case will be, by the time we get to the second question, maybe there will be deferred tax.
Thank you, sir.
And that's why I've explained that in this case, deferred tax is zero because we have no such information, or probably the information so exists, but it gives rise to no temporary difference. And the deferred tax for a no temporary difference is zero, because tax rate times zero is zero. Any other question? Any other question?
No, quite understood.
Okay, now let's look at this question. This question one. Now let's repeat that and let's look at question two. Let's look at question two. Let me switch. We'll read question two for us as I switch. Question two.
All right. Faramadi PLC financial information is as thus. Estimated tax charge for the year 100 million naira. Over provision in relation to previous year 10 million naira. Deferred tax liability opening balance 5 million naira. Deferred tax liability ending balance 3 million naira. Required, what should be reported as income tax expense in profit or loss for the year?
Okay. Let me switch it. I've copied it and okay. I will copy this template. Now, they didn't put the year there. Let's just say as at 1st December XXX. Okay. Now, the estimated tax for the current year is 10 million. It's 100 million. Yeah. And we are told that there was over provision with respect to prior year, which means if it's over provision, we treat it as a reduction. We have overcharged ourselves. Therefore, we have a tax credit to use over provision in prior year. And the over provision already is calculated for us at 10 million. Therefore, it reduces our current year tax. Okay, therefore our current tax in that year is 90. Now deferred tax. Now they've computed deferred tax because they know we are not yet mature to compute deferred tax. Now they've computed the deferred tax balances, opening and closing. Therefore, what we are interested in is the movement in deferred tax liability. We are told there was deferred tax liability. Therefore, we compute the movement. Remember, you've seen something like that before. Okay, let me show you where you've seen it before. If you go back to the templates, the model I developed then, remember we had it here. Can you see? Opening balance, closing balance is the difference between opening and closing that gave us this balance, as you can see here. That movement is how we recognize deferred tax credit and deferred tax charge. Okay, therefore we'll come back. Now, what is our opening balance? Therefore, deferred tax liability, DTL, as at 1st of January 20XX. Was set to be 5 million. And the balance as at 31st December XX is set to be 3. Now, what is the movement? It moved from 5 to 3. It moved by 2. Now, this movement, we are now interested in, is it going to create a deferred tax expense or a deferred tax liability charge, credit? Now, look at it. Remember, when we did conceptual framework, a reduction in a liability without parting away with cash, will it give rise to an income or give rise to an expense? I'm with you. In this case, it's a deferred tax credit. Why? Because our liability has reduced from 5 to 3 without paying anything because it's a mere measurement. We are comparing our provision last year with our provision this year, and we have had a reduced provision for a liability from 5 to 3. And therefore, this gives us a credit of 2. And when you have a credit, remember, current tax is a charge, which is an expense. Okay? Or expense, as the case may be. Now, we now have deferred tax credits. Now, deferred tax credits is an income against that expense, which means it's going to be used to reduce the expense. But if this has been, let me say 8, therefore, this will have been deferred tax charge. And this charge will have increased the charge here. And therefore, it increases our aggregate amount. Which means, as I've said earlier, and we have shown, a deferred tax credit or income will reduce your current tax charge to arrive at your income tax. Okay, and that's what we've done here. But again, that was returning back to what it was. And that is that. Any other question? And that's what they want us to do in this situation. Any question?
Okay, my question is,
yeah.
No, we did not. What should be reported as income tax in the profit or loss for the year? So now this adjustment we have made will be seen at the face of the profit or loss for the year. Or
what you report as income tax in profit or loss is 88 million. 88 million as considered the prospective adjustment for last year. First 90 million as adjusted for prospective accounting for over provision in relation with last year tax. And second, 2 million tax credits from deferred tax as adjusted for the difference between taxes recognized for tax purposes and taxes recognized for accounting purposes, which is a deferred tax credit in this case of 2. But if it's a deferred tax charge, it will be an addition of 2 to the 90. Does that answer your question?
Yes, I perfectly answered my question.
Okay.
Because what I was thinking is that when we are working in our profit and loss, we'll make provision and we calculate our income tax based on 30%, as in the rates, the prevailing rates.
You now multiply it with your profit or loss.
Yes, and then
that's not what you do now. That's not what you do. That's why we have gone through all of these processes last week. You will compute your current tax based on the law and adjust it for deferred tax and over or under provision. And that's how nobody in today's world
I've actually not similar 6th class.
Nobody will pick accounting profit on the financial statement and multiply by 30% and say that's a tax. That's not tax. Thank you. Okay, over to you. Madam Jason, over to you.
Sir. Yes. Sorry, sir. So I want to ask that, is it going to be the same movement or the same method approach if it's a movement in deferred tax assets? Hello, sir.
Yeah. Can you repeat you?
Okay, I said that the way we've gone about it now, is it going the movement in deferred tax liability that we've done, and then we've been able to apply, reduce the current tax charge by the deferred tax credit based on this deferred tax liability. Is it going to be the same thing if it's deferred tax asset?
Yes. For example, if it's deferred tax assets, let me show you. If this is deferred tax assets, that means this is not let me say it is assets. Now say it's assets. Now, the situation will change. Now there's a decrease in assets from 5 to 3. Therefore, a decrease in assets, you understand, is going to be a charge. why an increase in assets would be an income or credit. Remember, we've distinguished between an asset and liability, even from the conceptual framework. Okay, if you remember, we said what creates an income? What creates an income is an increase in an asset, okay, that brings about increase in equity, which cannot be attributed to additional equity participation from the owners of equity. And an expense is more or less considered a decrease in an asset that brings about decrease in an equity and cannot be regarded as for equity participation. Similarly, from a liability perspective, we said an income is represented by a decrease in liability that brings about decrease in equity, and such cannot be attributed to additional capital contribution. And an expense from a liability perspective is as a result of an increase in liability other than a participation or increase attributed to contribution of additional liabilities. And that's what we have used, which means you must have understanding. When your asset is growing within you, you are creating an income. When your asset is depleting within you, you are creating an expense. When your liability is growing within you, you are creating an expense. When your liability is reducing within you, you are creating an income. Does that answer your question?
Thank you, sir.
Okay. Take note of that, okay? Now, any other question? If none, let me now quickly, these questions only tends to refresh our memories with respect to, what's it called? With respect to current taxes and income taxes. Now, let's pick a question that might speak to deferred tax. Now, can we look at question 4 in this case? Can someone read question 4? Can someone read question 4?
Okay, question 4. A planned purchase at cost 500 million naira. Tax depreciation to date has amounted to 220 million naira, and depreciation charged in the financial statement to date is 100 million naira. The income tax rate is 30% required. Which of the following statements is or are most likely to be correct in accordance with IAS 12? A. The provision for deferred tax in relation to the asset is 36 million naira. B. The tax base of the asset is 280 million naira. C. There is a deductible temporary difference of 120 million naira. D. There is a taxable temporary difference of 120 million naira.
Thank you very much. Now let's copy the question and attempt to provide solution to it. Okay. Now let's pick the information one by one. We have plants, which we can infer that this is an asset, have you? The plant is an asset. We have the cost of it, and the cost is said to be in Naira, 100 million. In Naira. Okay, accounting depreciation, chart so far.
So I think the cost is 500 million.
Okay, thank you. The cost is 500 million. Accounting depreciation is 100 million, yeah. And tax depreciation, who can tell me what tax depreciation stands for? What does tax depreciation stand for? When you hear tax depreciation, what are they talking about?
Allowance.
Yeah, correct. They are talking about capital allowances. Okay, it's 220. Tax rates. Income tax rates is said to be 30%. Now, the issue is this: in line with IAS 12, to determine what are correct or what are not correct, we need to look at it and ask ourselves a simple question. The first question we ask ourselves is, what is the carrying amount? The plant, which is an asset. What's the carrying amount as a reporting date? I can say the carrying amount is a difference between the cost and the accumulated accounting depreciation. Now, the cost is how much? 100 million. Sorry, the cost is 500 million. The accounting depreciation so far is 100. Therefore, this is the carrying amount. Again, the second question would be, what is the tax base? But somebody asked me, we've not discussed tax base, we discussed it, but at this point, it's very easy to determine. It's still the difference between the cost and the accumulated tax depreciation, which is already computed for us, or capital allowances. And what's that? 220. And that's 280. Now, at the end of the day, the next question then is, what is the temporary difference of the assets? The temporary difference of the assets is a difference between the carrying amount of the plant, which is an asset, and the tax base of the plant, which is an asset. What's the carrying amount? The carrying amount is 400. The tax base is 280. What is the difference between 400 and 280?
120.
The difference between 400 and 280 is 120. The question then is, what form of temporary difference is this? What form of temporary difference is it? This 120, is it taxable, is it deductible? And we say since the carrying amount of how much? 400 million is higher than the tax base of 280 million of the plant, which is an asset. Hence, the temporary difference is deemed taxable. Therefore, that's our conclusion there. That is that. Now, the next question then is, what amount and form of deferred tax will this give rise to? Now, since it's a taxable temporary difference from what we have here, it then means that taxable temporary difference will give rise to deferred tax liability because it will expose us to higher taxes in the future. Therefore, we say this is deferred tax liability, TTL, which is equal to the tax base, so the tax rate, in this case, 30%, multiplied by the taxable temporary difference of 120 million. Therefore, if that is the case, what amount does it report to? 30% times 120, and that gives us 36 million. Now, that's it. Now, we can now ask ourselves, which of the following statements is most likely to be correct in line with IAS 12? Let us pick it one by one. The provision for deferred tax in relation to the assets, which means asset plans, is 36 million naira. Is that correct? One, they refer to assets, and two, they refer that we should make a deferred tax provision of 36 million, which is what we got here, which means it's correct. Therefore, I'll mark it right. I say this is correct. The tax base of the assets is 280. Is it correct? The tax base here is 280. Is it correct?
Yes.
The deductible temporary difference is 120 million. Is it correct?
Yes.
Hmm?
No.
The deductible temporary difference is 120.
No,
No,
correct,
120
sir.
no.
Not correct.
the
No,
120
not
million naira
correct.
is correct, but
Not
deductible temporary
deductible.
difference
No,
is
not deductible. Yes, it's not correct. It's the next one.
Mommy, I want that
Okay.
to put it on. I don't want it.
Can you please unmute when you are not talking, please? Now, final one, there's a taxable temporary difference of 120 million. Is that correct?
Yes, sir.
Okay. And that's how you solve problems. You pick problems one by one. You start from the known to the unknown, from simple to complex. And that is it. Does it make sense at all? Does it make sense at all?
Yes, it does.
Yes, sir.
Let us now look at another illustration here. Illustration 8. Illustration 8. Can somebody read?
Arsenal PLC made a taxable profit of 10 million naira year end 31st December 2015, on which income tax is payable at 20%. The following information are provided with respect to its income taxes. A deferred tax charge of 150,000 is required to be made to income tax expense for the year. The opening balance, the opening balance in the deferred tax liability account was 250,000. There was an estimated tax for the year ended 31st December 2014 for the sum of 1.5 million. But tax has now been agreed at 1.6 million naira and has since been fully paid in 2015. Current taxes are payable every 30th June of the year preceding the year of assessment. In the year 31st December 2015, Arsenal PLC made a capital gain of 300,000 on disposal of a plant. This gain is taxable at the rate of 10%. Determine the income tax expense for the year to 31st December 2015. Determine the tax liability to be reported in the statement of FP as at 31st December 2015. That's all.
Okay. Thank you very much. Now let's switch to our spreadsheet. Now we have to determine our income tax. Therefore, I can borrow these templates. Which year is it? 2015. Okay. Current and deferred tax. Now let's start with current taxes. I made the taxable profit of 10 million naira. And that means that if the taxable profit for the year is 10 million naira, and the tax rate, income tax rate is 30%. What percentage? No, sorry, 20%. Therefore, I can deduce to say my estimated tax, estimated current tax, which in this case, current tax with respect to company's income tax. Is this. Is a product of these two. That is 20% times 10 will give me 2 million. Okay, I think let me do everything in thousands. I'll prefer to do it in thousands so that I can give me better visuals. Therefore, this 10 million, 10,000, that's that. Okay. Okay. Now this is my current tax. Now we're told something here. That there was an estimated tax for 2014 for the sum of 1.5 million, but tax has now been agreed at 1.6 and has since been fully paid in 2015. What it means is that there is the need for us to add to the current year tax on that provision for 2014 income tax. How do I arrive at that? We compare final and agreed 2014 tax with the FRS, and we compare it with the self-assessed tax by the company in 2014. And 1.6 is what FRS, we agree with FRS as final tax, but we provided 1.5. Therefore, all things being equal, we have under provided how much? 1.6 minus 1.5, which means the current year our current year company income tax after adjustments is 2.1. Now, but we also have additional current year tax, which is capital gain tax. Remember, capital gain tax is a current tax or is an income tax, CGT. And CGT was said that we had a capital gain of 300,000 multiplied by the tax rate for capital gain tax was 10%. Therefore, That means 10% of 300,000 will give me this amount. Okay, all in all, my total current tax for the period total current what? Tax for 2015 is 2,130,000. I'll link it, 2,130,000. That's why we call it current taxes, because it can be made up of the following, if I'm to refresh your memories once again. What are those things? Remember, it can be made up of company income tax, tertiary education tax, information technology development levy, NASENI, MPF, capital gain tax, and the likes as it affects you. Okay. Now, but also we need deferred tax. Now, luckily here, they've given us a deferred tax charge for the year. A charge is an expense, okay? Therefore, I can come here and say, we have a charge of 150, straightforward. Now, but the question also says, determine tax liability to be reported in your balance sheet. Therefore, what are the tax liability? The first one to report is current tax payable. Let me pick this one down so I don't waste much of my time. Current tax payable. Okay. Now, last year, it was 1.5 million we provided, which is carried forward to this year. This year, we have charged, as you can see, 2,130, which means all things being what? Equal, I have 3,630 to pay. But in 2015, how much are we told we have paid? We have agreed 1.6 million with the tax authority and are still paid in 2015. Therefore, I've paid how much? 2,150. Now, in that case, I reflect what I've been paid or what I've paid. Therefore, what I'm carrying forward, what I've paid is 1.6, sorry. 1.6. Therefore, I'm carrying forward 2030. How do I carry this for 2030? Remember, 2,000 is my actual tax for the year, plus 30,000, which is my actual tax for the year. But this 100 was additional tax relating to 2014, which I need to pay along with the 1.5, or if I've already paid the 1.5, they'll give me a demand notice within 21 days, 30, 14 days as the case may be, or as it applies, to pay this additional 100, which I have to pay. I'm not carrying that forward to next year. What is paid on a preceding year basis are your actual taxes. For example, the 2 million and the 30,000 CGT. And that is the amount to carry forward as your current tax liability. Now, the other one you also bring forward is your deferred tax liability. Okay? Deferred tax liability. Now, remember, the information provided here was that the opening balance of your deferred tax liability was 250,000, which means your balance brought forward for deferred tax liability was 250,000. Now, your charge for the current year, your charge for the current year is 150. Remember this 150? Therefore, at the end of the day, what is the balance you are moving forward? As you all know, expense will increase liability. And therefore, my new liability has now increased from 250 to 400. That's why also we have said that any increase in liability will be attributed to an expense. Okay, which means this is a balance I'll carry forward. In this case, as a non-current liability, and that's why you must show it separately. Deferred tax liability is not current, current tax liability is current. Okay, and this is how we produce this, which means on a platter of goods, we can see the position we hold with respect to the question. Any question? Any question?
No question.
Any other person? If there's no question, we'll now look at one simple but elaborate question. Okay. Now let's look at this question. And this question will expose us further to some basic things. Now question 12 here. Question 12, can somebody read?
Paramola PLC starts a business on 1st January 2011 with an initial capital of 1 million invested in the acquisition of plant for its operation. The activities of the company in its early stage are minimal, of which accounting profit for the relevant years 2011-2014 are fairly stable at the sum of 400,000 per year. The AP was after all operation costs, including depreciation, have been charged. The company depreciation policy requires a straight line basis of cost allocation. The Inland Revenue Service requires the cost of the plant to qualify for capital assets, that is, tax depreciation of 50, 30, 20 on cost for year 1, 2, 3, respectively. The corporate tax is 40% and has remained unchanged. Determine the following: current taxes for relevant periods, deferred taxes for relevant periods, income tax expense, that is / income for relevant periods, effective tax rate for relevant periods. Thank you. That's all.
Hello, I want you guys to deliberate on it for the next 10 minutes. What do you need to do? And after then, I'll try and provide solution to it and further guidance. Over to you guys. Somebody can volunteer to lead the team. Thank you. Now, based on our discussion so far, we'll look at this problem. I believe you guys have perused it at your level. And let's look at it in this manner. Okay, now let's look it one by one. Formula PLC started business on 1st of January 2011 with an initial capital of 1 million. And the 1 million was invested in the acquisition of plants. Okay. The activities of the company in its earlier stage are minimal. And we are told that the accounting profit has remained evenly distributed over 4 years and are fairly stable at 400,000 per year. The accounting profits was after all operational costs, including depreciation, has been charged. The company depreciation policy requires a straight line method, and the Inland Revenue Service requires the cost of the plant to qualify for capital allowance, or what they call tax depreciation, on the basis of the following. First year capital allowance at 50% on the cost. Second year allowance 30% on the cost. And last year allowance 20% on the cost, which means the allowance are granted over a 3-year period. The corporate tax rate is 40%. And this rate has not changed. Okay, now we are faced with the following. What are the following? Now we are to determine the current tax for each relevant year, deferred tax for each relevant year, income tax for each relevant year, and effective tax rates. Now let's start like this. For the first year, 2011, the profits was 400,000 naira. All figures in thousand. I will need to carry out necessary adjustments. The first adjustment is to add back depreciation, which we don't know. I'll call it X. The second adjustment is capital allowance for the year, which will be deducted, which I don't know. Let me call that Y. Since this is our first year of operation, the opening balance of capital allowance is 0 because we have no capital allowance forward as this business just commenced in the year. Now, if that is the case, we then need to know X and Y. And to know X and Y, this working sheet will be relevant for us. And what do I need to do is to say, my first year in which I have the car, or I have the plant in this case, the cost of the plant was said to be 1 million. Now, for both accounting purposes and tax purposes, they are both 1 million at the point of origination. But we are told that the assets, the company has a policy of straight line method. And the useful life of the asset is presumed to be 4 years, which is the relevant period between 2011 and 2014. Which means if you are to use accounting treatment, your depreciation each year will be the same. And it will be based on cost minus scrap value, which will give you your depreciable amount and divided by 4 years. In that case, there's no scrap value. It means the residual value in this case is 0, which means the entire cost is depreciated over 4 years. at the rate of 250,000 per year. Therefore, how do I get that? I make the relevant computation, which is 1 million divided by 4 years. And that's how I got 250. Okay. Let me borrow something here. Now 250. Now, which means this 250 is the amount of depreciation I'll recognize for year one, which means my kind amount in year one will be, sorry, my kind amount in year one will be 750. How is this 750? The cost minus the depreciation for the first year, which means my kind amount is the book value in accounts, 750. But what I needed is this 250 for now, which is the depreciation I need to add back, all because this 400 was arrived at after deducting depreciation. It is here. The 400, the accounting profit was after all operational costs, including depreciation. But the tax law does not allow this depreciation. Therefore, what will I do? I'll add it back. It's 250, which means my adjusted profits or accessible profits, as the case may be, is 650. Now, what is my Y? My Y is that I'll use the same principle here to determine it based on the principle of charging capital allowance. Now, they've provided us information of how capital allowance is derived, which can vary from jurisdiction to jurisdiction. But in this case, the jurisdiction says capital allowance for year one is 50% of the cost, as you can see here. Now, 50% on the cost, what happened in that case? I can compute that 50% of the cost. If I'm to do that, is 50%, you can see it here, of 1 million, and that is 500,000. Okay. Okay, therefore, in that case, I have the capital allowance at 500, which means my Y is 500. Okay, now what is my tax written down value? My tax written down value is simply the balance for tax purposes, which is the tax base. Whereas the same balance for accounting purposes is what we know as 750, which is the carrying amount. Okay, therefore, that's the position there. Now, doing this, I've been able to produce my carrying amount, and I'm also able to produce my tax base. And what's my tax base? Is 1,000 minus 500, which gives me 500, as you can see here. Okay. Now I can come back here and say this sum up to what I'm awaiting absorption. And in this case, if there's no restriction other than availability of accessible profit, I'll be able to absorb how much? The entire amount. Okay, which means I should be able to absorb the entire 500. Now, being able to absorb the entire 500 means that I will charge the entire 500 to my taxable profits, which means I'll come here to deduct that. Okay. Now, what then is my taxable profit? My taxable profit is now the assessable profit less capital what? Allowance, and that gives me 150. Now, the tax rate in the information here is 40%. Therefore, I'll come here and say 40%. And what is my current tax? It is 40% times the taxable profit. That's 16 million. Now, take note here. If peradventure we have balance, let me say this is 400. We have balance of 100. This balance of 100 will be brought forward to the next year. And that's what it means here. But since there's no balance here, what will be brought forward next year will be 0. And that's what I'm trying to do there. Take note. Remember, we can carry over on utilized capital allowance to the following year. Similarly, on utilized tax losses. And this is how we determine current tax for 2011. Now, to do the same thing for 2012, we are also told that the profit in 2012 is not different from 2011, which is also at 400,000. Therefore, we'll come back here again and say this is 400,000. Now, what is my deduction for the year that I'll add back? If you remember, we'll come back here. Deduction every year is straight line method, which we have agreed. And therefore, what will I do? I'll recognize for the second year the amount of depreciation. Second year is 2012. Okay, and that's 250. Okay, now my balance in that year is 500. Remember, after you deduct your depreciation, that is that. Now, which means in 2012, I'll also add back this depreciation, which you can see here. Now, my capital allowance also will be computed. Which is 30% in this case, according to the information here in year 2. And 30% is what? And therefore, what is my balance? My balance here as tax base will be 200, while my current amount is 500. Okay? Therefore, I do that. In this year, I come back and say, my capital allowance for that year addition is what I have here as 300. Which that means the same thing I've done here. I will sum it up and it's 300 because this is 0. Imagine this is 400. Therefore, it means the 100 is carried forward plus 300 give me another 400. Let me say this is 380. I carry forward 120 plus 300 gave me 420. But that is not the case. The entire 500 was absorbed. Okay, we also come here. What was absorbed, we can absorb the entire 300 because there's profit sufficient enough to absorb it. Okay, why? Because my profit here is also 650, which means I can absorb this entire 300. And what is left is nothing to be carried forward. I'll link that. Therefore, which means at the end of the day, if the rate has not changed, I have 350 profit now, taxable at 40%, and it will give me 140. And that is that. Okay. And that's how we do it, and we repeat everything until we fully depreciate and until we fully amortize. And that's what we've seen until the final year. We repeat the same thing for the tax base. Okay, we repeat the same thing here. Okay, and that's how we obtain all of this. Which means I can say these are my tax written down value, which is also the tax base, and these are my net book value. And that's how we produced everything until they are fully treated. Now, the difference in the recognition between accounting depreciation and tax depreciation is what I can infer as a timing difference. As what? A timing what? Difference. Well, let's complete this other table. In similar vein, we'll complete this other table and get similar results. And if you complete it at your end, you also find out that you arrive at what I've gotten, which means the profit has not changed in 2013 from 400, the depreciation has not changed, you still have 650, but what is changing is the capital allowance, which as at the end of the last year, it is 200, all because we have applied 20% in year 3. Okay, and in that case, what do you have? 200. We can absorb the entire 200, and that's what we've done at that point. Okay. Now, in this case, all things equal, we have been able to estimate our current taxes, which is what we have here. 60,000 in year 1, 140,000 in year 2, 180,000 in year 3, and 260 in year 4. Even when the profits remain the same, tax is increasing in the year. Why? Because tax authority are not seeing this profit or are not adopting this profit. Rather, this is the profit they are seeing. And this is not the profit that is shown in the financial statement. Therefore, people cannot understand when your accounting profits remain the same, tax rate remain the same, but the taxes you are paying to the government is increasing. Therefore, there's no explanation you can make that they will understand, because they are not privileged to understand that the view of the tax and the way the tax authority has more or less considered your profit is invariant with accounting practices. And therefore, this profit is not seen or known to them. Likewise, all of these adjustments are not known to them. And in that case, one thing is to conform with the law by recognizing that these are my taxes payable. The other thing is then to come back and make some accounting measure to adjust this in order to reflect tax that reflects this accounting profit. And that is that, which means at this point, we have been able to answer the first question, which is determine the current taxes for the relevant period. And we have done it for each of the years. Remember, you must know your position of last year to roll it over to this year. You must know the position of this year to roll it over to next year. And that is how taxes are being done. Okay, now, second one is to determine the deferred tax. And therefore, I'll use the template to determine that. To determine the deferred tax for each relevant years, I know that deferred tax will arise from temporary difference. And this temporary difference are differences between the carrying amount and the tax base. In this case, it's only an asset we are considering based on the limited information we have. Plants, which is an asset. Therefore, we are computing deferred tax for the plants. Now, what is the carrying amount of the plants and the tax rate for each of those years? And luckily, we have been able to do that as we are computing the depreciation and capital allowance. Each of the years, these are the carrying amounts for the plants for financial reporting purposes: 750 in year 1, 500 in year 2, 250 in year 3, and 0 in year 4 because it has been fully depreciated. And for tax purposes, 500 at the end of year 1 is the tax base, 200 at the end of year 2, 0 at the end of year 3 because over 3 years is where you are supposed to claim capital allowance. And by year 4 too, it is nil. Okay, in that case, I can simply more or less link my schedule to that. Doing so, if I'm to link it, produces this result, which is not far-fetched from what I've just explained. Now, since I've done this, the next is to look for the difference between the carrying amount and tax rate for each of those years. And if I look for the difference for each of those years, what I have are 250 in year 1, being the difference between 750 and 500, 300 in year 2, difference between 500 and 200, 250 in year 3, difference between 250 and 0, and none in year 0. And this is why we call it timing difference. Now, at this point, this difference reverses. At this point, the difference originates. It originates. Okay, and that is that. Between the period it originates and it totally reverses is a timing difference. Okay, if you remember, I made mention of it here, the timing difference. Now let's come back here. Now, the tax rate has not changed. We are told that the tax rate remains at 40% throughout the entire period, which means here we won't be looking at substantively or enacted. Everything is enacted, all because the 40% remain unchanged over a 4-year period. And I'll come here and say 40%. Now, as I said earlier, this temporary difference, is it taxable or deductible? It's taxable because all through the periods, the carrying amount of the asset is greater than the tax base. And therefore, all of these differences are considered taxable. And because it's taxable, when you apply the relevant tax rate, it gives rise to liability, or because it's going to bring about increase in future taxes. Therefore, what is our tax liability for each of the year is a product of the tax rate and the taxable temporary difference, or simply put, multiply the tax rate with the taxable temporary difference, and you get this. By so doing, these are the amount of tax liability. Initially, it was 100. Over time, it grew, it dropped, and it came back to 0. Why does it come back to 0? Because 1 is not a tax, and 2 is just a temporary difference that gives rise to it, which the difference will go off over a period of time. And we're going to see that as a proof. Okay, therefore, the next thing is to look for the movement in this deferred tax liability. Initially, we started from 0 at the beginning of 2011, and now we are reporting 100 at the end of 2011. And this is a deferred tax liability, and neutral tax liability has increased from 0 to 100, which means the first year we recognize the entire increase, 100. Now, the next thing is, in the second year, it has grown from 100 to 120. Now, which means there has been a marginal increase from 100 to 120, which is the difference between 120 and what? 100. It has increased again. Now, these increases in deferred tax liability, as we have displayed earlier today, are considered as an expense, which means we are talking of deferred tax expense. Now, but again, between year 2 and year 3 is dropping, and it has reduced from 120 to 100, which means we are getting a credit. Okay. And finally, it dropped from 100 to 0, which means again, we are getting credit of 0 in this case. Now, at the end of the day, we see this as credit or an income from deferred tax perspective. Now, let me borrow something. Okay, and that is that. Alternative to what I've done here is that you can start like this and say, okay, at the beginning of the year, you have no balance. And if you have a balance, you put it there. Now, at the end of the year, we had 100 million balance. Based on that, what has been the movement in the year? Sorry, that's not 100 at the end of the year. Based on that, what has been the movement in the year? The movement in the first year has been the difference between this 100 at the end and 0 at the beginning, which is this. And we said that is an expense. Okay, now we repeat for the second year. The balance at the end of the first year, which is 2011, is your opening balance at the beginning of the second year. And the balance at the end of the second year, we did it, it was 120. Again, what is the difference? 20. And you recognize an expense. Now, again, the opening balance in 2013 is the closing in 2012. And again, what's our balance here? 100. And at the end of the day, what did you do? You see that it's now reversing. And this is a credit. Okay, remember, we have it here. Let me put it in negative. Okay, and again, in 2014, your opening balance is the closing in 2013. And in 2014, valuation at the end of the year is 0. And therefore, what do you have? The entire 100 has reversed. And that's which means whether I use this approach or use this other approach, you are still going to arrive at the same destination. But what matters most is the understanding. Okay. Now, why do we say deferred tax is no tax? If you sum up all of the movement over time, it sum up to 0. You can see it here. It sum up to 0. You can also replicate it here. If you sum it across, it's still summing up to 0, which means deferred tax is not a tax. This has further justified that deferred tax is not tax. Take that from me. Okay. Now, the third question says, what is our income tax expense or income for the relevant period? Now come here. What are my current taxes? I'll pick all my current taxes as earlier done. 60, 140, 160, no, sorry, 180 and 260. Now, what is my deferred tax expense or credit? I have this 100, 20, negative 20, which is credit, and negative 100, which is credit. At the end of the day, what is my income tax? It's 160 across board. And what does that mean? If you sum up the actual tax you are paying to tax authority each year based on the law, 60 in year 1, 140 in year 2, 180 in year 3, and 260 in year 4, you've paid how much? 640. If you also go back to your financial statement, how much you have accrued evenly or smoothly over the years is 160, 160, 160, 160, respectively over a 4-year period, 640. Therefore, what then is deferred tax? You still find out that deferred tax over the years is no tax. It's still pointing to the same direction that deferred tax is not a tax. Which means it's an accrual measure of carrying out a smoothing effect such that your income tax is a reflection of the tax purportedly on your financial performance. Okay, and that is the position of the law, of the standard. Any other question? Now, the next thing is, what is it? Okay, what's your question?
Yes, my question actually relates to the estimation of deferred tax expense or credit. Now, based on accounting terminology, what do we call this this difference? That 100, I understand is an expense. So do we call it over provision or I don't know? I just want to get the terminology. I know it's an expense. So
what we have called it is what we have called it is deferred tax expense, deferred tax charge. Therefore, what do you want to call it again? You've already named it as deferred tax expense, which is different from current tax expense. And where it's applicable, deferred tax credit. Therefore, what name do you want to call it again?
Yes, I was actually relating it to what's it called? The question we solved earlier, where we had an increase, like at the beginning of the year, we had.
That is totally different. That relates to current taxes, where you might over or under provided. They are two separate things.
Yes.
There's current tax as a component of income tax. There's deferred tax as a component of income tax. You don't mix it up. They are totally different. They are addressing different things. but they are still working together to derive income taxes.
All right, so thank you.
Okay. Now, effective tax rates. The last question was effective tax rate for relevant period. The effective tax rate here is trying to look at your income tax, not your actual tax, which is current tax. Your income tax as a ratio of your profit before charging that income tax. Now, if you see here, our income tax is evenly spread as 160 over the years. Whereas our profits is 400,000 over the years. Therefore, what then do we do? You find out here that your effective tax rate is the ratio of your income tax to your profit. Therefore, what's my income tax? 160 divided by my profit for that same year, 400. 40%. In year 2, it's still 160 divided by 400. In year 3, it's still 160 divided by 400. In year 4, it's still 160 divided by 400. And when you look at it, this 40% is closer or similar to this corporate tax rate, which means we have more or less tend to reflect this corporate tax rate on our accounting profit by saying 40% of this 400 will have given us 160 million or 160,000, whatever it is. And that is the objective we are trying to achieve, which means when we have a perfect situation and there are no permanent differences or rollover temporary differences, our effective tax should always steer towards our corporate tax rate. But because the reality of it is that there are permanent differences and other rollover differences, the two will not be the same. Therefore, that will trigger reconciliation. And there are two approaches of reconciliation, which we're going to look at later. And we're going to look at that is you must always try to reconcile either your corporate tax rate, that 40%, to your effective tax rate, which might be different, or you reconcile your accounting profits to your taxable profits. These are the things you need to take into consideration at this point in time. Now, let me see whether I can plot something. Let me see whether I can plot something so that I can show you something here. Let me show it here. So that probably I can have a plot. Yeah. Accounting profits. I'm sorry. Yeah. Current taxes. Income taxes. Each of the year 2011 to 2014. Current taxes was this. Income taxes like this. Okay. Let me try and plot this. Okay, this is not what I want to plot. Okay.
We can't see this.
You can't see the screen?
We can't see what you are doing.
Are you sure you can't see it? Can you see anything now?
Not yet. We are just in the, what's it called, the spreadsheets. You know.
You didn't see a chart?
No, just the spreadsheet.
Okay, but can you see something now?
Still the sheet.
Okay, can you see it?
Yes. Where is the sheet chart?
Yep.
Yes.
You can see figures in front.
Yes.
That's what I'm showing you. Now, I want to plot this. Let me plot it as a line chart. The initial plot was showing a bar chart, but you guys said you didn't see it. Okay. No. Let me see. Okay, let me filter the year out of it. Let me just plot these two side by side and take the year out of it. Okay. Now, this is it. Can you see the chart? Can you see the chart?
Yes, I can.
Yes,
Okay.
you can. I can. Okay, I can.
Okay, therefore, these are each of the years, year 1, year 2, year 3, year 4. Let me just call this current versus income tax chart. Now, you find out that this is a break-even point. But before this point, you have your current tax lower than your income tax. The difference between these two, this is our actual road, but this road is not motorable, which means there's more or less a hill. And to make it motorable, what do? We collapse this top of the hill. And that's how they construct roads in all those Utah. They cut this off, pull it down, and use it to fuel here. At the end of the day, you're able to have a motorable road that shows a straight line. And you now see that you are passing through a valley. And that is what deferred tax is doing, which means the gap here to here is a deferred tax. The gap here to here is a deferred tax, and it is the gap to give you the amount of your income tax, and whereas this is your current tax. Okay, and that is similar to this chart I have earlier that I drew. It means you try to smoothen the line, which you can see here. as against your initial line, which you have here. And that's the position we are trying to show. Okay. Any other question? There are more discussions to be made, but this is where we stop in part 2 of it, which means what you should look for, what you should expect in part 3. In part 3, as follows. 1, what happens when there is a change in the tax rates? In this case, there was no change in the tax rates. 2, what happens and how does such affect deferred tax computation in a situation where there are tax losses and or capital allowances unutilized and allowable to be carried forward for tax purposes. What happened in that situation? Third is, what is tax base? And how is tax base of an asset and liability ascertained? Fourth, what are the exemptions available with respect to recognition of deferred tax? 5, the 3 schools of thought on deferred tax recognition. Now, which one do we consider? Next, the effect, if any, of time value of money principle and discounting on deferred tax computation. We'll look at deferred tax implications on other transactions, including business combinations. Okay, what other things do I believe we need to look at in deferred tax? Okay, I think we also need to reevaluate. Reevaluation of sources of differences in accounting profits and taxable profits. Okay. Okay, we'll look at reconciliation of corporate tax rates with effective tax rates and or reconciliation of accounting profits to taxable profits. And we'll end up with relevant disclosures with respect to income taxes in line with IAS 12. Okay, these are the things we need to watch out for in our part 3, which may be our conclusive or concluded part. Any other question? Any other question? Any other question?
So there was a content you showed to us earlier on deferred tax. I don't know if you are going to share that with us as well.
What content?
Like a spreadsheet on like the one you did on
Yeah.
it relates to deferred tax something, deferred computation.
Yes, as I've explained, I'll provide it, but again, it is not giving a la carte in the sense that you can't be able to replicate it. You can't be able to replicate it if you don't have understanding of it, and you might not be able to fully utilize it or effectively use it, even when the template is made available without you having understanding of all what we have discussed, which means the template is just a giggle, like any other application, which means it's garbage in, garbage out, which means if you put things wrongly, it will process it wrongly and give you wrong results, which you might wrongly utilize, and which users of financial reports can also wrongly adopt to make a wrong decision. Do you get what I'm saying now? But again, we have access to it. That is not a problem. Any other question? In the absence of anything to the contrary, I think at this point or junction, we want to call it a day based on all of our interactions. Any other question? Okay. Good night and God bless you all. Bye.
All right, thank you.